Hi, thanks so much for joining in. You're watching Beaky Prime. My name is Alex Matthew, and we're in conversation with the management of Bandhan Mutual Fund. It's been an interesting year that they've had so far because they've had a rebranding, and in fact, they have a couple of products or offerings to talk about. We're joined by the Chief Executive Officer of the company, Vishal Kapoor. Thank you so much, Vishal, for taking the time. And, at the onset, before we get into the nitty-gritties of how the fund sees the market as it stands right now and the offering that you have currently open, I want to understand from you how this year has been from the position of rebranding and telling your investors and prospective new investors about the change that is happening at your end.
Thanks, Alex. Thanks for having me, firstly. And I must tell you that it's been absolutely gratifying to go through this process of change of the brand, as our investors and our partners will understand that a new brand with a new set of shareholders has brought a lot of energy to the team. And the receptiveness, the openness with which our investors and partners have reacted has been absolutely heartwarming for us. And we are well past that now. We are well in our 6 months almost as Bandhan Mutual Fund. And we've had now great success with both new products that we've been able to bring to our investors, as well as expand our presence and our franchise. So all great so far. Thank you.
So could you talk about some of the offerings that you've had, not the latest one, but some of the new schemes that you've launched over the course of the last 6 months?
I think, our first offering as Bandhan Mutual Fund, as we were just making the transition, was a very interesting idea, leveraging really at the international debt opportunity that the US interest rate markets presented. As I think most of your viewers will be aware, the US debt markets have had interest rates now at almost historically high levels. And we were able to quickly structure a product which was at that point in time intending to benefit from the inverted yield curve, where we were effectively offering through a fund of fund structure an access to the US Treasury 0 to 1 year range. And the US Treasury, as most investors will understand, is among the most safe or the highest safety product available. And with the yield levels almost touching 5%, 4.5% to 5%, it presented a very interesting opportunity for investors looking to benefit or wanting to create an asset into the US dollar market. And that's a product that we were quick to get off the ground. Since then, we've also offered a few smart beta products, as well as some active products in the form of a financial services product, as well as an IT index product. So these are, again, themes that we think could offer a lot of opportunity, and therefore something we were happy to structure and offer in a fresh manner for investors.
Now, I looked at the schemes that you've got on offer, and it's pretty much the whole suite of offerings, which is why I wanted to get that picture out there and also try and understand how you're seeing or how the fund is seeing the current juncture. I was looking at your fact sheet as well, and there was a mention in that the tactical indicators suggest that it's time for a correction, at least from the small cap end of the spectrum. So where do you think that Indian equities currently stand at, and what are the opportunities that you're seeing?
So there's almost like a split picture, if I can call it that. At the equity analyst level, when we have what our analysts are seeing and what our equity team is seeing, is a fairly good domestic market opportunity. So when you talk to companies which are really domestic consumption focused, or some of the sectors that got left behind during the COVID phase, which seem to be rebounding now, there seems to be good visibility on earnings, and therefore relatively lower risk if we were to look at fast forwarding to earnings growth over the next year or 2 years. The question of valuation, of course, can always be asked, but at a micro level, at a stock specific level, in many cases we would be comfortable with the valuation that you're getting, and therefore for a stock picker it may be an excellent market to look at. Therefore, we are quite constructive even on spaces like a small cap fund, which we offer through our emerging business fund, where the quality of the portfolio, as well as what we're able to find in terms of new opportunities, looks quite rich and quite robust. Having said that, we want to caution investors that if you are coming into equity, you have to look at several years. And given the other half which I talked about, which is global indicators, which seem to indicate a fair amount of risk of slowdown or recession, depending on which market you're looking at. Don't get too unnerved with volatility. So if you can stomach some amount of volatility in the near term, we don't think the opportunity in Indian markets should be worrisome in that sense. And therefore, please don't try and time the market. If you're okay to stomach some volatility and look at it for the next 7 to 10 years, this could be as attractive a market as any, given the visibility on strong earnings that we can see in most of the companies we are talking to.
Without getting into individual securities, I was looking at just the sectoral picture in the portfolios of various schemes that you have on the equity side. And I see that there is a large allocation to banks. And I know that you or several of your funds try to play that consumption theme. But in a few of them, I'm seeing 20+% allocation to banks. And I guess to a certain extent, that kind of mirrors the benchmark. But why is it that you have in your actively managed funds such a large orientation towards bank? Why are you overweight?
So financial services in general, we do think will be a good theme to play out over this current decade. Like I mentioned earlier this year, we brought out a financial services fund, an actively managed fund. And it's not just banks, but we do think there'll be opportunity across the other aspects of financial services. A lot of them may be newer ones like, asset management, insurance, broking, other capital markets, fintech, NBFCs, etc. So financial services in general may be a good opportunity. The entry point and which part of the market you want to be overweight on is, of course, something that we keep shifting a bit. But that structurally we think is quite strong. And therefore, again, for the long-term investor, if you're not trying to time it too closely, that's a structural or a theme that we think one should be overweight on.
So speaking of the long-term investor, it brings me to the latest offering that you have in the market. The NFO is open as we speak. And this is a solution-oriented product. It's a retirement fund, which is following the policy of a dynamic asset allocation fund. Correct me if I'm wrong. What is the thinking behind launching something like this? And the reason I'm asking it like that is because you would necessarily have to lock in for a period of 5 years.
That's right. So, Alex, for that fund and something that we think is really a core need that each of us individuals, whether you are in the accumulation phase, which is you're far away from retirement but you're working and you're earning, or where you're getting close to the distribution phase or you are now retired. At both levels, there are some structural challenges that we need to address. And this is just coming out of both research as well as some trends that we see. So let's maybe talk about those. Firstly, I think most of us underestimate how quickly expenses will build up and inflation in general, right? So if you ask people around, if we do our maths ourselves, we'll be shocked to see how inflation builds up. And therefore, the corpus that we're targeting during our earning years for our retirement purposes may actually be smaller than what we need. So that's risk number one. Risk number two in that phase is also that most of us can tend to be very conservative in investing that when during the accumulation phases. We are happy to put it into a tax saving product or a very static product or a PPF account, etc. Lock it in and hope that it builds up. But we're not probably giving it as much of a growth boost to equities as it maybe deserves. And increasingly, given the factor that we are living longer, our average life expectancy is going up, and the younger generation wants to work shorter. So our expectation of retirement age is actually coming down. Recent surveys expect or suggest that people want to retire by maybe 50 or 45, not even the 58 and 60 which the earlier generation was looking at. You have lesser number of years of earning. So lesser number of years of earning combined with the longer lifespan you have, it means much more, extent of number of years for post-retirement that you need to fund for, means that corpus requirements will have to be really reassessed. And in our view, that provides this very core objective we must solve for, which is how do you really build a robust retirement plan? And our product is trying to do that in a modest way.
Okay. Now, based on the structure of this scheme, you have up to 35% that you can put in debt, but you can have a much lower than 65% in equity because you can play that arbitrage theme as well. So I'm just trying to understand how the strategy of the fund is going to operate. In what situations will you be completely underweight on equity, and how far would you be willing to take it?
So this product tries to simplify life. So in the retirement space, in the industry, there are multiple models available between aggressive to moderate to conservative allocations. But in our view, the need right now is simplicity more than choice. And sometimes the too much choice can actually confuse us. Now, in a simple product, if you have to look at the average, the saver or the earner who's looking to build a retirement corpus, but importantly, also someone who's close to retirement or has just retired. So let's say you're 60 and you still want some amount of growth assets. You don't want too much risk because, end of the day, this is your retirement corpus. And you still have maybe 15, 20, 25 years of a lifespan that you want to fund for. Therein, we think that the balanced advantage strategy or the asset allocation strategy is actually a far better way to solve this challenge than any one asset class. Now, with any balanced or asset allocation strategy, one will need to look at macro factors, some amount of quant and momentum factors to see how much equity, how much debt, which is where we are employing our proprietary model to decide between equity and debt in terms of active equity allocation and debt. Classically in the industry, it's known as the balanced advantage or the multi-asset, category, and that's what we think is the right strategy for a retirement solution. We also think that the advantage of equity taxation is something most investors can enjoy, and therefore, at all points in time, this product should have the benefit of equity taxation, which means equity, both active plus passive or arbitrage, should be above 65%. Although active equity can come down all the way to 30-35%. So based on market signals and indicators, we can make it more conservative or aggressive based on where we see the opportunities. So with that one strategy, given the need for simplicity for the retiree or someone who's building towards retirement but does not want to take enormous risk, we think that this model should actually serve you best in terms of producing risk-adjusted returns that are actually beating inflation, beating your alternative, and therefore leaving you with a far better corpus than your alternative today.
Fantastic. Vishal, thanks so much for joining in and for giving us that perspective. It's been an insightful conversation, and look forward to our next one as well.
Thank you for having me.
All right, so that was the management of Bandhan MF speaking about a range of issues, and towards the end about the new fund offer that they have open right now. And that specifically is what I want to ask a financial planner about, and whether or not you should consider getting into a solution-oriented mutual fund scheme. What are the pros and cons? So to give you those answers, I'm joined by Kirtan Shah, the Managing Director, Private Wealth at Credence Family Office. Thank you so much, Kirtan, as always, for taking the time. And not necessarily speaking just about Bandhan MF's retirement-oriented scheme, but in general about such schemes. What are the pros and cons that one has to bear in mind when they're considering investing in them?
Alex, thank you so much for having me on the show. Alex, there are two things that you would want to look at as an investor. First is a solution-oriented scheme is largely intended so that you hold on for a long time, right? So if you're looking at retirement planning, even if you read most of these NFOs and the offer documents, they would say that retirement planning typically would be a 12, 15, 20, 25 year kind of an investment horizon. So when you are investing for such a long period of time, right, you, irrespective of your risk profile, right, you would largely want to capitalize as much as you can in terms of market opportunity. But let's say, for example, if I'm a moderate or an aggressive investor, and I have 15 years to go for my retirement, I would really want to allocate more and more money towards equity, or probably even 100% of my allocation towards equity, because this particular goal is a long-term goal. And for this particular goal, I can have 100% of my investments into equity. The problem with all solution-oriented funds is all of these funds are hybrid in nature. So if I'm an aggressive investor, I have 15 years to go for my retirement. In general, I would have allocated 100% of my money allocated to this goal to equity. But unfortunately, because I'm taking solution-oriented funds, I am forced to move to an hybrid structure, which may not really be the kind of solution that I'm looking at from a 15-year goal perspective. So that's the biggest problem, at least in my opinion, when I look at solution-oriented funds. Of course, along with this, there are these smaller problems, like there is a 5-year lock-in, and all of us have been trying to spread awareness around why not have investments.
So why don't you spell that out? Why is a 5-year lock-in a problem?
So, Alex, typically what we are trying to do is try and give flexibility to investors to choose whether or not do they really want to stay invested or not. When you particularly talk about an NFO, you've got no background of how this product is really going to pan out, right? Now, in such a situation, if you lock me in for 5 years, and even if I realize whether or not there is a problem in the product, there is a problem in what I understood, or probably what I thought was the objective is not matching to what the objective of the fund is, I should really have the flexibility to move out, right? When you try and lock me in, there is so much that goes against me versus going for me. Of course, there's a large advantage that it takes care of the undisciplined investors, right? Because we've in general seen that people don't stay invested for long, right? And 5 years in that context is way too long for a lot of investors. But for an investor who's probably understands, is disciplined, would not want to lock himself, herself up, because there are so many of these opportunities available, and I should be free to explore all of these.
Sorry to break in on that, but even for the investors that's not very confident that they can trust themselves with getting time or breaking the investment, would you say ELSS is a good option to consider, considering that it's a shorter lock-in, 3-year period, and it has tax advantages?
Oh, undoubtedly. I mean, if I have to, try and replicate a similar structure, I would rather want to do an ELSS, because ELSS has been around for a long, long time. There are 20 plus options that I can look forward for. I know what these kind of funds have been able to do over market cycles over 10 years, 15 years, right? And at the same time, if I'm still following the old tax regime, I get tax advantage, which is of course the case here. But in general, there's a 3-year lock-in. I know the experience. I've invested. I have multiple options available, right? So if I still want to choose a hybrid, right, and if discipline is a problem, then ELSS is a far better option. But like I said, for me, if I'm an aggressive investor, or even if I'm a moderate investor, but allocation is goal-wise, right? So if my goal is 15 years from today, I might want to give as much equity allocation possible to that particular goal, and not want to restrict myself with 35% of fixed income, right? Just because the product is meant to be hybrid.
All right. Thanks so much, Kirtan, for that perspective. And now I'm sure that our viewers have a more holistic understanding of the subject. And viewers, by the way, in case you have something to tell us, do write to us on the comment section on any one of our social media platforms, and do follow us and subscribe for a lot more. This is BQ Prime.